morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we take a look at the results of CIBC First Caribbean International Bank Limited, or FCI, for the 9 months ended July 2016. With a market capitalization of just around 11 billion TT, FCI accounts for about 1/10 or 10% of the Trinidad and Tobago Composite Index, meaning that changes in its share price does have a meaningful impact on the direction of the overall movement of the composite index of the local economy. Let's take a look at some of its highlights. And for the 9 months ended 2016, earnings per share for FCI advanced some 28%, up 10 cents to 46 cents against the 36 cents recorded in fiscal 2015. Interest income, while declining 1.1%, and that should be about 24 million, was offset by a larger than proportional fall in interest expenses, leading to an overall increase in net interest income by about 3.3%. Ultimately, profit after tax climbed some 27%, or closer to 28%, from $583 million TT to just about $744 million. So what does that mean from an investor perspective? Well, on a trailing basis, FCI's trailing earnings per share is around 51 cents, already exceeding that of the 38 cents recorded in fiscal 2015. Fiscal 2014 was a particularly difficult time, with some one-off expenses and write-offs being realized in that year, leading to a loss per share of just around 59 cents. However, from a dividend yield perspective, FCI continues to be relatively stable, and at this moment, excluding trailing dividends, offers investors a trailing dividend yield, excluding special dividends, offers a trailing dividend yield of 3.8%. And this is largely on account of a run-up in its stock price of just about 40% year to date. So, as we can see, in terms of performance drivers for FCI, revenues have improved markedly in the 9 months of 2016 and have increased to just around $2.67 billion, its highest level in the last trailing 5 comparable periods. We see that this would have been driven in large part by operating income, which has increased considerably and consistently over the past 5-year periods, moving from about $672 million in the first case in 2012 to just about $835 million in 2016. Net interest income as well would have improved and recovered to more stable levels of about $1.8 billion TT for the 9-month period of 2016. This revenue stabilization, along with cost containment and improvement measures, would have led to improvements in the profit before tax margin for FCI. And how does that manifest itself? Well, we see that profit before tax margins, or PBT, is currently at a 5-year high of just about 31%, as we can see. So what can we expect going ahead for FCI? Well, in the first instance, revenue stabilization is quite a positive driver, despite the outlook for some of the major operating jurisdictions for the company. As we can see, Barbados and Bahamas account for just over 50% of revenues, with relatively muted outlooks. However, there has been some stabilization in FCI's revenue despite these challenges. The Cayman Islands and Eastern Caribbean also account for 13% and 9% respectively. Based on the last annual report, Trinidad accounts for just about 2% of total revenues. Cost containment has also been another positive driver for FCI. Post its balance sheet cleanup in 2014, whereby a lot of one-off expenses were written off, namely loan loss related and other expenses, there seems to be some moderation in its expenses related to loans. So, from an investor perspective, again, when we look at FCI's relative valuation from a price-earnings multiple standpoint, we see that it's trading fairly in line with the banking sector average of about 14 times, and FCI's multiple is 13.8 times, meaning that it's right along the range of where other banking stocks are trading. Importantly, FCI pays its dividend in US dollars, which provides a double benefit to investors of, one, a hedge against any weakness in the Trinidad and Tobago dollar, but more attractively, an access to a US dollar income stream while investing in an asset that is denominated in TT dollars. And here we can see that you don't really pay extra for this benefit, with FCI's dividend yield being 3.8%, pretty much in line with its banking sector peers, as well as a moderate payout ratio of around 53%. So in conclusion, based on improving financial performance, dividends that are paid in US dollars, and a relatively moderate valuation from a price-to-earnings multiple, Bourse places a buy rating on FCI. That is for this week's edition. For more information on these and other investment themes, give us a call at 628-9100, visit our website at bourseinvestment.com, or email us at invest@boursefinancial.com. This has been the Bourse Report, and let's go to a quick commercial break.